So first of all, welcome and thank you everyone. We are here to listen to the case for an Australian Clean Commodities Trading Initiative. Very fortunate to have Elizabeth Thurbon and Oliver Yates join us. I've heard both of them speak independently on this topic and others, and so we're thrilled to have them talking on the West Coast to the whole of Australia and beyond. But before we start, I would just like to acknowledge the traditional owners of the lands of which we're meeting. At Curtin, it's the Whadjuk elders, and pay our respects to all of the traditional owners on the different lands where people are coming. As I always say, the energy transition, I think, is creating new opportunities and a lot of hope for participation and equity. And it's a real privilege to be working with the different PBCs and traditional owners and other Indigenous people on this as we move forward. I'll just read a very brief bio and then hand over to our speakers because that's what you're here to listen to. So Elizabeth is Deputy Head of School, Director of Research and Professor of International Political Economy in the School of Social Sciences, Faculty of Arts, Design and Architecture at UNSW, and also Director of the Green Energy Statecraft Project, which is a really interesting project and a collaborative initiative between UNSW, University of Melbourne, Sydney and ANU, looking at the possibilities for a more ambitious and strategic approach to energy transition governance. Might have to come back to you on that too, Elizabeth. I'm in Singapore in a couple of weeks talking about China, so it would be lovely to rack your brains. And Oliver Yates is currently the Australian Country Head of GAW Capital and Board Member of the Smart Energy Council, having been the first CEO of Australia's Green Bank, the Clean Energy Finance Corporation. And his global experience in both the private and public sector regarding climate change policy and finance. So two wonderful experts who, you know, I've enjoyed sort of the pleasure of interacting with at different times. As always with our webinars, we will have the Q&A going, so you can put things in the chat, but we'll look to those towards the end. From the point of view, there's a whole lot of information and that has already been put in the Q&A, I think, so there will be information available for you at the end. So I'm going to hand over to the two of you and look forward to the presentation. Thank you.
Great. Well, Liz, shall I start or would you start or shall I start, Liz?
I think it's you, Ollie.
Okay, well, look, everybody, thank you and good morning in Perth anyway, and it's almost towards the middle of the day in the rest of Australia. So thank you for joining us today. I'm obviously delighted to provide a brief opportunity and a summary of the Clean Commodity Trading Initiative. As mentioned, in the website, you've got some details, and I'm going to assume a reasonable level of familiarity with the proposal. But hopefully what I really want to do is I want to unpack the macro logic of the proposal. And to give you a background, look, I've been in this space or this game for almost 40 years, and I've in that period looked at these type of problems from the side of a financier, a developer, an investor, and in the situation of running public money to achieve a public policy purpose. So I hope the perspective I bring is actually quite helpful. Now, at its core, the CCTI is designed to turn the dream of becoming a leading global clean commodity producer into reality. So it's about accelerating the construction of these clean commodity production projects in a way which is targeted, it's efficient, and it's strategic. And it's vital that I just stop here at this point and make sure you all understand what we're talking about when we talk about a clean commodity project, because it's not really a steel plant and it's not really a smelter. It's much bigger than that. So each one of these projects is actually a massive interlinked undertaking of eye-watering investment scale. And it's important people understand that when we talk about a green steel plant or a green ammonia plant of, let's say, 1 million tonnes, we're talking about a plant that costs $2 to $3 billion. But you'll be forgetting a lot more of the facility that needs to come as part of that plant, which is integrated. The hydrogen facility, the batteries, the renewable energy facility. So that's adding about another $6 billion. And if we were to take the example of a green aluminium smelter that we've all been talking about, Tomago, well, you know, if Tomago was to be powered with green energy, it would involve $12 billion of investment in renewables and storage. So if I was to talk in direct, you know, Bob Catter style, and you don't want to smack in the chops, I really want to drive the message home and make sure you understand in Bob Catter's language that the average investment size we're talking about is a size of $10,000 million per facility, $10,000 million facility. Now, SAF is perhaps the least capital intensive, and I'll talk to you about one of the longest and largest attempted biofuels projects, being RDA, that's in the outback of Charters Towers, out the back of Charters Towers. It's an alcohol to jet facility. Again, very easy to say, an alcohol to jet facility, snap, easy. Doesn't that sound great? But what does it really mean? It means I need all the capital to build the farm infrastructure to grow the biofuel. I then need an ethanol plant to process the sugar cane into ethanol. I then need a biomass plant, power plant to power that. Then when I have the ethanol, I need an alcohol to jet facility to be attached. And then I need an integrated transport facility to move that to from Charters Towers to Townsville. So even that project, even the cheap ones, we're talking about $2,000 million each. And frankly, none of this can be financed efficiently on a private sector balance sheet without a blisteringly strong regulatory demand, which simply does not exist. And if I put my financier's cap on the moment, I'd say we're not stupid. We remember government's track record. If I go back to the RDA example, which was the biofuels project, that has been tortured for 15 years. Queensland eventually announced a 4% liquid fuel mandate back in 2018. And it was, quote, a legally binding liquid fuel mandate. Yet, it's not been enforced. So the current penetration of liquid clean fuels in Queensland is still below 4%, and not a single fuel reseller has been fined. So none of this works without a binding contract or blisteringly strong and enforceable regulatory demand that the government of the day won't flinch on. And unfortunately, governments of all persuasions in Australia have shown a pattern of behaviour that make it really hard or impossible financiers or investors to pony up the billions and billions of dollars that's required to build these facilities without a legally binding contracted offtake. Now, as was confirmed by participants at the recent Green Steel conference we went to in Adelaide, and again, to drive this point home, the idea that a bank would finance $6 billion of renewables against the balance sheet of a yet-to-be-built clean commodity plant that lacks a super strong long-term offtake is a joke. Conversely, they said the idea that you could finance a $2 billion clean commodity plant hoping someone would kindly build you $6 billion worth of clean power facilities to attach to it is bonkers. Look, the market won't clear. Banks won't take project on project risk. Banks and financiers don't trust billions and billions to new government regulation that the next government can overturn or simply ignore. And that's exactly what the CCTI is here to solve. So the CCTI here is to solve that really big barrier that's preventing clean commodity production facilities entering construction now, as a result that they lacking these long-term bankable demand at a price that allows construction to even start. So we all know, we've all been crowing about it, Australia has the minerals, it's got the technology, we got the available capital to become a leader, but the projects like the green iron projects, the green ammonia projects, sustainable aviation projects are stalled. Not because we lack the ability to being a world-leading producer, but because the market currently won't pay the premium necessary for the production of a clean product over a dirty product, and the contracts are not there. So right now, you and I, taxpayers, we're exposed to the compounding risks of climate change. And we want our government to act. So exposing the government finances to some additional risk to reduce the risk and the compounding risks that we as taxpayers face with climate change makes sense. But simply, no one is going to build a $3 billion iron plant plus another $6 billion of renewable energy and hydrogen facilities that it will need without clear visibility of a contract from a creditworthy party that guarantees that it can sell its product at a predictable price higher than its cost of production. And that creditworthy party is likely to be the government. And this is not a supposition, it's actually a fact. So currently in Australia, we lack dependable regulatory rules that trigger and enforce that demand. Currently, commodity buyers are not compelled to buy an increasing proportion of low emission commodities. It's the government that sets those rules, and the governments have not put those rules in place. And this is the core problem or issue that the CCTI solves. Those rules are not in place. They're in the government's controls, but this allows the government to step in now and take on that regulatory risk itself so that projects can move to construction. So shock horror, this process asks the government to take risk on its own future actions. And in taking that risk on its own future actions, it actually reduces the risk that we all face as citizens with climate change and enables projects to move forward. So the CCTI is simple. It just involves the government signing long-term offtake contracts for these green commodities, accepting the risk of their own actions. It takes the risk that the government flinches on its own actions or regulations itself. It doesn't ask the private sector to take that risk. The policy involves signing bespoke offtake contracts for the selected projects that are ready to proceed now, tailored to their own specific costs and timelines, to guarantee the purchase of the clean commodities produced by those selected projects so they can get built now. It doesn't involve taking risk that the facility can produce the commodity. It just takes a risk that if they do, they'll receive an agreed price. Now, only governments can actually take that risk about the agreed price because the largest or a very large proportion of that price risk is the regulatory risk. It's the price of that green premium, and that is 100% in the government's control. So this isn't about subsidies. It's about allocating risk to the party that can best manage it. Also, it's really important as a side issue that we remember that in the world that we're heading into, which is a renewable energy world, it is capital and the cost of capital that determines your power price and then your global competitive position. In the old days, it was, did I have cheap coal? Did I have cheap oil or cheap gas? That was a major driver of competition of your competitive position. Today, it is the cost of capital because the renewable energy facilities that power all of these are so capital intensive. And that cost of capital is actually a function of the credit risk that the credit providers face. So if Australia is to be competitive, we need to ensure that our power facilities are financed with the cheapest capital possible, and we all know how that can be achieved. So let's talk about the clean commodities and what happens, because in the documents you'll see we talk about them being kind of like in two parts. So when you buy clean commodity, effectively there's the product, a lump of green, quote, iron ore, and I have had people think that maybe it's green, but it's not. Green pig iron is not green. It looks the same as everything else. But then there's the premium price or the environmental attribute. So in comparison to a dirty one, dirty price is this. To make it clean is this. The difference is the clean premium, and that's a price effectively of the environmental attribute. So if I want to make that green, how much extra do I need to pay to make that green? So effectively, in a commodity, say iron or ammonia, you can sell it into two markets. You can sell it either as a dirty product. You could just sell it as, oh, well, it's just ammonia, don't worry about it. Same as every other stuff, no special attributes. Or I could sell it as a clean product and this is clean, or otherwise I can even detach the certificate and say, I'll sell it dirty, detach the certificate, hold on to the certificate, and I could bank that certificate. I could bank those environmental credits and work out how am I going to be paid? How do I earn back that premium that has been necessary to produce that? Now, those clean credits that you've ripped off effectively could be sold into some compliance markets like the European CBAM, but I think more likely they'd probably be banked by the government and then sold into the new regulatory system that I think we all know is coming, which we know the government has to mandate, and we know they have to put in place, because if we don't get clean commodities into production, we will never meet our climate objectives. So effectively the government could get these things produced, write the contract, sell the dirty physical, hold on to the environmental credit, and then wait for it to put in place a scheme, or there's a global scheme in place which is within the government's control that sets a level, and that level of ambition will actually drive the price. So what's the government taking? Oh, well, it's taking a contract for commodities. Great. It's going to sell the raw commodity, and it's taking risk on the future value of a credit today that it actually controls the price of that credit in the future. So this makes it quite a fiscally responsible way to de-risk the investment from the government's perspective. By contracting now and banking the credits, the government is getting ahead of its own regulatory system, which it controls, and ensures Australia leads rather than lags in all these opportunities. Importantly, if you look at this policy tool, it's a transitional tool. By doing this and writing the contracts, it gets on with the job of building early projects so we get them off the ground now, so that eventually when we do have all of these regulated markets in 5 to 7 years, Australia has the capability, the skills, and actually the trading relationships it's in business. And then when the regulatory scheme actually applies and arises and private buyers emerge, the CCTI's role naturally tapers off. It'll probably offload the clean commodity credits that it's banked, getting its money back, and it avoids then the ongoing pitfalls of open-ended support. It creates a pathway for this early support the government's provided, which looks long and massive, to end, with a potential full recovery for the early support. As the markets mature, if people think the carbon price is going to be where it is in 10 years' time, I can show you it's probably not. So the government is probably going to be able to trade those credits into the market at a higher value, recovering the support. So the CCTI policy is a policy which isn't just about economics. I'm more of an economics, and Liz is going to talk about statecraft in a minute. We're talking about starting construction now on a selected number of projects that will trip off the construction of significant mega-scale renewable and hydrogen projects behind it. It'll show for once and for all that the government can deliver on its future made in Australia, as the offtakes will trigger investment and action. It'll unlock private investment across the projects, so the ecosystem can be funded without huge government public outlays, but it can be funded at the lowest cost of capital possible. It'll create regional jobs right across the supply chain. It'll create all of these alliances with international with international governments potentially, which Liz will talk more about. And it'll prepare us for a world of green trade rules, targets and mandates that'll be critical if we're not going to flinch on our climate targets. And crucially, the CCTI policy is a policy that's budget smart, because it supports the support is targeted, and the contracts are customised and limited to a small number of projects. The public funding is repaid over time as markets mature, and it's one of the few policies around that actually the government could potentially make a profit out of in due course. So I'll close my discussions and pass on to Liz in a moment. But remember that the CCTI policy is a precision tool designed to move a select number of projects into construction by offering them tailor-made offtake contracts. It'll underwrite the price of those products produced for those selected early projects, triggering that wave of investment that I've talked about right across the supply chain, and give us a real shot at becoming the clean energy superpower we all crow about. It does it in a way which is fiscally and risk responsible. It can move us from promise and puff to construction and production in a highly responsible way. So please read the papers that are provided there. They're provided in the links. And if you support the logic, pressure the government to take this risk on all our behalf. Projects around Australia are being cancelled and developers are going broke waiting for action. Many of you on this call are the very policy holders that control the levers that determine whether we'll see green steel, green ammonia and SAF plants built at scale in the term of this government. You have to take very active and direct role, as the scale of these projects actually need it. So let's take strong and effective demand side policy action like the CCTI or something similar, and get construction underway on a selected number of projects this year. And Liz, I'll pass over to you. Thank you.
Thanks a million, Oliver. Fantastic. And as Oliver mentioned, my job today is really to put the CCTI into broader geostrategic context and explain why it is the essential policy instrument for our time. So in the next 10 minutes or so, I'm going to do three things. First, I want to identify the most important geostrategic development of the 21st century and three related megatrends that now present some massive new risks and massive new opportunities for Australia and that therefore demand our strategic response. Second, I'll explain why a government-backed CCTI has to form a part of Australia's strategic response. And finally, I'm going to explain why the most recent global shocks related to the actions of the Trump administration only amplify the need for a CCTI. And so my key message is really that given the huge risks and opportunities now facing Australia, a CCTI isn't just a sensible new policy idea, it's very much a strategic imperative for our country. So let's start with the most important development of the 21st century and the risks and opportunities it's created for Australia. And that development is, of course, China and its remarkable rise and its embrace of an entirely new approach to promoting national development and relatedly national security. Much more than a decade ago now, China started doing something that no one in the West predicted or until relatively recently even acknowledged, and that is that while governments elsewhere were wringing their hands over whether to put a price on carbon or meaningfully subsidize green industries, the Chinese government was just getting on with it, starting to build and scale the world's largest renewable energy system and one that now dwarfs all others by a massive margin. And why was China doing this? Well, it wasn't to address climate change. It was doing it because its government understood that speeding up the energy transition is a massive national security multiplier. So by speeding up the renewable shift, China's policy leaders knew that they could boost energy security by reducing reliance on fossil fuel imports, which is a huge expense and a huge strategic vulnerability. They could boost economic security by creating the new high-tech export-oriented manufacturing industries of the future. They could boost environmental security by reducing particulate pollution and helping to mitigate climate change. And they could boost social security by creating thousands of higher skilled, high paid jobs in manufacturing and service industries, especially in regional areas. And they could boost geostrategic and military security by demonstrating the nation's commitment to environmental issues, enhancing international status and prestige, and attracting new allies, especially among developing countries. So in sum, China's leaders embraced the green energy transition because they saw it as this unprecedented opportunity to advance a comprehensive national security enhancing agenda. And it's very much worth pointing out that this opportunity was not just there for China, it was there and it remains there for any country smart enough to grasp it, including us. But China was the first mover and it moved with this speed and scale that is really breathtaking, and it moved with massive implications for Australia and for the economic model that's really underpinned our national prosperity since the 1970s. And that model basically involves, as you know, digging up and shipping out commodity exports, mainly iron ore, coal and gas, the majority of which finds its way to China, Japan and Korea, to power their globally competitive export-oriented manufacturing economies. And China's actions then kicked off three megatrends that now have huge implications for Australia and our future prosperity and security. And specifically, these trends have really undermined the viability of our existing economic model, posing a huge risk to our national security and prosperity. But thankfully, they've also created massive new opportunities if we're smart enough to grasp them. So I'm briefly going to identify these trends before explaining why they make a CCTI an absolute urgent imperative for Australia. So the first megatrend is this rapidly declining cost of renewables, which thanks to China's massive investments are now the world's cheapest form of energy. And this has made fossil fuels a much riskier bet, as we know, and really changed global investment logics. Global investment has now swung very firmly behind renewables, which now attract about 2/3 of global energy investment. So the second mega trend then is related, and it's this growing willingness of governments across the globe to embrace ambitious green industry development plans and embrace net zero commitments to stimulate investment and address the climate risks. So since the COVID crisis, this has swept large parts of Asia and Europe and many emerging economies. It also very briefly swept to the USA, a point I'll return to in a sec. But while the renewables trend is now global, it remains the strongest in Northeast Asia, where countries like Korea and Japan also understand the security enhancing potential of the energy transition, and they're also betting big on the industries of the future. And indeed, the scale of China's investments have helped it emerge as the world's new economic and technological superpower to rival the United States. And that brings us to this third mega trend, shaping the risks and opportunities that confront Australia, which is growing geostrategic rivalry between the US and China, Australia's most important economic and security partners, respectively. The US obviously woke extremely late to the China challenge, but it's now trying to recapture its leadership in a swathe of the technologically and technology-intensive advanced manufacturing industries of the future. And under Biden, renewables became that front line in this techno-economic war between the superpowers. The $1 trillion IRA was very much America's signature policy in this regard. And while it was targeted at China, the IRA had huge implications for all countries. And one of the most important was that it helped legitimize a much stronger and more strategic role for the government in the green energy transition, something that the Australian government has long resisted despite the obvious imperatives. Indeed, America's IRA finally sparked the first meaningful policy response from Australia to this changing geostrategic context that I've just described. And that response came in the shape of Future Made in Australia, which is a really landmark development. It signals that the Australian government now fully grasps the enormous risks and opportunities now confronting Australia. The most pressing risk, as I've mentioned, is this challenge to the viability of our existing commodity-based dig and ship model centred on carbon-intensive industries. Some of those risks have been quantified and are frankly quite alarming. Consider iron ore, our top export industry that currently generates about 140 billion in annual export revenue. Modelling shows that those revenues are likely to halve as China, Japan and Korea restructure their carbon-intensive iron and steel chains to advance their green ambitions. But it doesn't have to be this way, because once again, Australia, if I can say it, has been kicked in the ass with a rainbow, because Australia possesses not only some of the world's best mineral deposits, but also the world's best renewable energy resources. And East Asia's decarbonisation also creates huge new opportunities. Specifically, we can use our cheap renewable energy to move up the commodity value chain, processing our iron ore to create green iron. And modelling shows that replacing our unprocessed iron ore exports to Asia with that green alternative could about triple the value of our existing iron ore exports. And this would be a massive boon for export income, but also for government revenue and also for job creation. But this opportunity we face isn't just economic, crucially, it's geostrategic as well. Because a bold shift towards green iron and clean commodities more generally would allow us to further deepen our vital economic and strategic partnerships with our Northeast Asian neighbours, especially Japan and Korea. And in particular, Australia could help Japan and Korea in their quest to decarbonise their economies and maintain the viability of their most important export industries, especially steel, and related industries like automobiles and shipbuilding. And we know steelmaking accounts for a whopping 6 to 8% of global carbon emissions, and Asia's steelmakers are now staring down this barrel of Europe's CBAM, which really renders their carbon-intensive industries increasingly unviable. So Australia now has this chance to forge valuable new strategic partnerships with our Northeast Asian neighbours, centred on collaboratively decarbonising our economies, retaining our economic competitiveness, and really laying the foundations for a new era of shared prosperity and stability. So this raises a crucial question: what policies will allow Australia to maximise these opportunities? To succeed, it's really imperative that we move with speed and purpose to position ourselves as the clean commodity supplier of choice for our East Asian neighbours. To do this, we have to mobilise vast amounts of capital. Oliver gave the scale, it's vast, to spur investment and innovation in clean commodities before other countries, frankly, eat our lunch. We really have no time to waste. So to succeed, we urgently need a policy response that's suited to our own context, because we're not China, we're not America. We can't afford their trillion-dollar subsidies. We now operate in a highly budget-constrained environment. Our budget constraints are only going to grow as we're forced to ramp up our defence spending to meet all these new geostrategic challenges. So now more than ever, the policies that we deploy have to be highly targeted. They have to be efficient, and they have to be effective, and they have to be politically durable. They have to have massive multiplier effects across a range of policy arenas, and they must deliver obvious value to taxpayers to maintain public support for the greening agenda. And on all these fronts and more than any other policy instrument, the CCTI would deliver. So as Oliver noted, this initiative wouldn't just add a highly targeted and efficient and effective instrument to the government's policy arsenal, it will be a huge investment and innovation multiplier. Because when you issue a purchase contract, it would give project proponents exactly what they need to mitigate investment risk and to unlock private finance. And by establishing a guaranteed purchase price for a product, it would turn the company actually executing these projects and their suppliers into R&D hothouses. It would incentivize them to innovate so that they can deliver the product at the lowest possible cost and reap that larger financial reward. So in this way, the CCTI is really strongly aligned with the government's major new focus on addressing the productivity crisis by stimulating private sector investment and innovation, and doing that crucially in budget-friendly ways. It's also aligned with the government's goal of strengthening strategic partnerships with two of our most important regional partners, Japan and Korea, because if the initiative was executed trilaterally, like in partnership with those countries, it would provide a crucial vehicle for cooperation to advance our shared decarbonisation agenda and our economic adaptation goals. It would send a really clear signal to other countries that we are willing to work together to advance goals that benefit the whole region, decarbonising our economies while generating new sources of wealth that can ensure that we actually remain development partners of choice for our neighbours across Southeast Asia and in the Pacific too. So time is really short. Let me just conclude with this final very brief point about the impact of the new Trump administration on all these risks and opportunities. So Trump's withdrawal from Paris and his repeal of IRA and the tariff wars have caused major disruptions, but these disruptions only amplify our opportunities and the need for the CCTI. Trump's actions aren't going to change China's commitment to its new national development model that sees renewables as a source of comprehensive national security. They're unlikely to reverse the 3 mega trends that China's actions have unleashed. The US actions aren't going to change the fact that these mega trends just mean one thing for Australia's existing economic model, which is to adapt or decline. And at the same time, Trump's actions have amplified Australia's opportunities and the need for a CCTI response. His attack on the IRA have triggered capital flight and labour flight, freeing up valuable potential resources for Australia if we play our policy cards right. And at the same time, Trump's chaos may have helped to solve one of the biggest barriers to renewable investment in Australia. the lack of policy certainty that came with the climate wars. Because Labor now has this clear majority and a clear mandate for its Future Made in Australia agenda. And this means that investors will have greater confidence to invest here. And finally, Trump's aggressive actions towards Australia have lent new urgency to the need to build stronger economic and geostrategic partnerships with our East Asian neighbours, especially Korea and Japan. The CCTI provides the perfect platform to advance all of these domestic and international policy goals simultaneously. For this reason, it's a really stellar example of sophisticated green energy statecraft. In some, it's not a nice to have. The CCTI is a must have if we want to seriously address the complex security challenges facing Australia, and if we want to have a real shot at maximising the huge economic benefits and the huge national security rewards on offer if we play our cards right. Thanks.
Perfect. Well, a lot of food for thought in there. It's so good to have you. I've got 1,000 questions, but of course I can't ask them all because I'm chairing. But I think it's also interesting with, the Shanghai cooperation that's going on right now with all the leaders from certain countries together, and it would be very interesting to be a fly on the wall in that room and some of the conversations, because I think, again, as you pointed out, Elizabeth, the leverage that's already happening where people are some countries are recognising that. And I think there's also a big discussion around autocracy and democracies and how that moves and shapes, the ability to move. But as you say, the government here does have a mandate, one would think, in what's happened post-election. And I, selfishly could bring it back to WA as well. So I guess I am interested in you have been talking, well, in my observation, you've been talking about this for a little while. So how are you finding the government's response to this? Because to me, as you've pointed out, Oliver, as well, it's a key, it is the thing that's required. And then I've probably got a follow-up one around WA, but what has been how is it going, I guess? How is government responding is my question.
Liz, do you want to have a crack at that, or shall I have a little bit of a crack at it?
Oh, you go for it, Aaliyah. Jump in after.
Okay, so look, I mean, it is interesting. The government has a very full agenda, and these type of suggestions are sometimes gratefully received, and other times less so, because they have a policy suite out there, and I guess one of the things that I think the policy suite, in essence, can be combined with this, but effectively, the whole variety of policies don't necessarily give you the demand trigger that's actually needed. So the production tax credit doesn't give you the demand, and the way renewable energy markets and curves work, the amount that has been picked, it's a number, right? And whereas if you negotiate a bespoke contract with a project that you want to get up, you actually negotiate the contract and it's going to, and it actually triggers action. Whereas picking a number and saying I'm going to give $2 a ton, or whatever it happens to be, you don't know whether that's arguably going to be too much or too little, and arguably I think we're probably going to see it's going to be too little in a way. So the government has a full agenda of this, but in essence, the CCTI is an umbrella. It actually basically says, okay, guys, we got all these type of things, but at the end of the day, we need this built. The government wants it to happen. How about I just write a contract? And frankly, maybe you don't get PTCs, and maybe you don't get this, and maybe you don't get that, because actually, if I just written a contract, you're up and running anyway. So it could actually form an umbrella that enables certainty for the government in delivering the key policy objective. And the key policy objective of all of their policies is to actually get Australia into production of these facilities, and that's exactly what the CCTI drives at. So everyone's got their agendas. How it all fits in, don't know. I mean, we're not really we're suggesting this because we're nice people, but I'm also suggesting it because I've been a developer, I've been a banker, and I've been on the public policy side, and simplicity helps. Certainty is critical for the level of finance we need, and timing-wise, deliverability. We're talking about, someone was asked the question in the group, how would you imagine, where would you see this fitting? So someone, the best institutional arrangement. Well, I mean, think about it in reality. We need a government department or a government department or an institution or a body like, IFIC or the CEFC to write 10 offtake contracts and manage 10 offtake contracts. And then you're away. You've got your first wave of projects into construction. So it's not asking, like, let's create, pages and pages of legislation. Let's just contract for a series of projects so we start this process, so we start this journey. Once we're on the journey, then you'll have other policies that you'll tailor to understand that may be applicable more broadly, but we're not starting the journey, and the policies we have at the moment are not delivering certainty that we are going to be able to start that journey. And that's what the CCTI is. It's basically the ignition to kick off these first early projects, and then hopefully other policies can be put in place around it to support it going forward. Liz?
Do you want to add anything, Liz? Or?
That was perfect. I mean, look, if I could just reiterate though that, we are seeing really, there's some really, really promising moves from the government. So I think the Future Made in Australia agenda is really excellent. And there's obviously I think there's a really growing recognition about the need for demand side drivers. I think that is a live discussion, and certainly we've been very pleased to have lots of conversations with various people in various parts of the government who are willing and receptive to hear new ideas. And I think that this is, a really great place to be in that sense, to have a government that's actually willing to have the conversations.
And Liz, I might just add one more comment into this issue of demand side drivers, which is the reason I raised the issue that you have in Queensland, is that, there's discussion about, let's just have a fuel mandate or something like that. You can see from the size of the scale of these projects that the bankers have a memory, and if they don't feel that legislative mandate is bulletproof, they're not going to be able to finance it anyway. And for the government to wrap a contract around its own risk, which is really what we did at the CEFC. I mean, the CEFC, it was specifically stated in our act that we could lend to people assuming government policy certainty, which would enable us to finance projects when there was a real risk that the RET was going to be torn up by the Liberal government at that stage and thrown out. All the projects stopped. And we could go into the market and say, no, don't stop your project. We're going to lend to you. And that policy, we're going to lend to you on the basis that policy holds, because that is the government policy of the day. This is just like the same thing. It's saying, guys, you're going to have to spend $6 or $10 billion getting these things up. We could put a mandate in place. We can do a variety of other things. But at the end of the day, you need certainty to spend that money. We're going to give you certainty. We're going to give you a contract for it. And really the risk on that contract relies back on us, the government. It's our own risk that the mandate's in place or the price for the green premium holds. So I think it's a very important clearing mechanism which enables all of these policies to actually be wrapped, delivered, and then financed, because the volume of money here is so large that without that kind of wrap around it to give that certainty, we're going to be struggling for a longer period of time.
So just responding to that, and I know there's lots of questions, so I can't take the thing, but I think about what's happening with Green Steel and Collie, and they were at the meeting you were at before, Liz. Really one of the things for them to unlock the finance is that they do need this offtake, and so but of course it's hard to do. It's hard to get there. So to me, it does seem if WA government's got an economic diversification thing, why wouldn't you? Because then, as you say, because that's also an important consideration for them to access funds from CEFC or National Reconstruction Fund.
Critical.
Without it, it doesn't unlock that government funding that's there to do exactly that thing. So it's really sort of quite unfathomable. The other thing though, Oliver, just briefly, is how do you talked about this when at the one I was before, how does this stop the next government in and changing it?
Well, if it's a contract, there's going to be very significant penalties. If you try and break a contract for the purchase price, it's going to be straight commercial law. You're going to be sued through the wazoo. So it won't get broken, and that's the very important part here. And if the government do want to rip it up, then they're going to have to pay penalties and damages to everybody. And it's kind of like critical. It's almost like the real glue that we need here in relation to these arrangements.
No, I think that's also an important point to make, that you know, the penalties. So let's go to some of the questions just to be fair to the audience. Rob Kelly asked, to what extent would Australia's opportunity to capture the opportunity of green iron undercut geopolitical priorities of our regional partners, a bit like we were talking before? Would trading partners like Japan and Korea rather back their own industries to decarbonise, even if this is higher cost and relatively higher emissions?
Liz, that's definitely yours.
Yeah, look, I think that's an excellent question. So the reality is, well, there are a couple of realities here, and some of them are competing and some of them are complementary. But one is that Japan and Korea have to decarbonize steel, their steel industry, if they want to remain globally competitive, and particularly if they want to keep selling into Europe, so with the CBAM. So that is a given for Northeast Asia. The other reality is that Japan and Korea in particular, but also China, see steel as a very significant strategic industry for both economic security and, frankly, military security reasons as well. So there is an obvious anxiety about anything that's going to undermine the viability of the steel industry, but there's also an anxiety about losing capability elsewhere, right? So if Australia starts saying, oh, you know, we weren't in on green steel. Why don't we become a green steel manufacturer and exporter? You can see that would be looked at kind of quizzically and unfavorably potentially too by Japan and Korea. So that proposition, Australia becoming a green steel producer, actually isn't what we're talking about, and doesn't make any sense whatsoever. What we're talking about is green iron, and the reality is that actually Japan and Korea, China's a bit different, but Japan and Korea physically really don't have the renewable capabilities to do the green iron piece in a way that's viable, certainly economically. So it actually makes really good economic sense for us to start thinking about and engaging in these conversations with Japan and Korea about what it would look like if there started to be less, vertical integration in steel production, if we started taking on some of that iron transformation in Australia, using our renewable energy resources and then essentially exporting embodied decarbonisation to them in the form of green iron to help them retain the competitiveness of their steel making. So this is a highly complementary proposition. That said, we have to help prosecute that case and make that clear in Japan and Korea. We're talking a lot about green iron in Australia. I think it's fair, and we're kind of, I think, also making the assumption that Japan and Korea would just logically go, yeah, that makes perfect sense. Actually, we need to make that case. We need to start having these really deep and detailed conversations to demonstrate a few things. One, that we're serious. This speaks back to this policy certainty bit, that despite years of climate wars and policy uncertainty, we are going to put policies in place that are going to stick, and that therefore we can be reliable as an exporter of green iron. This isn't going to be something that, if we have a change in government, like, for example, production tax credits that we know the coalition has already said they want to dismantle, we need policies that are politically durable to demonstrate to East Asian neighbours that even in the presence of political uncertainty, we will be reliable exporters of green iron. And then also to demonstrate to them that, we have the ability to execute here, and that we do see this as a long-term proposition. So this, it's a big economic task, but it's a big political task as well, and it's a big diplomatic task, and we have to pursue those things at the same time. I hope that answered the question.
Yeah, I think so. I mean, one thing that I won't distract. Well, one thing that I get so frustrated is, the superpower, the argument of large scale renewable. But to me, it's almost like we've missed the boat already in many ways. That Australia has. I mean, we've got the capacity investment scheme, but we haven't really sorted out traditional ownership, all of these things to actually unlock it at speed. Do you think it's because we haven't sort of sorted out the demand side that's causing the slowness, or you know, to me, I get eternally frustrated with this conversation that it actually, how do you move that beyond sort of thing?
Look, I mean, everybody should know this, that if you give the private sector a contract to make something at a price higher than what it costs them to produce, they will do it. You don't need to do any more. This is the kind of simplicity of this. We've seen it so well from the renewable energy industry. If you write a PPA, the facility will get built. End of story. The private sector will do it, right? So as long as the price is high enough, you can just go to sleep and say, right, I've written the big contract. See you later, alligators. Hope you guys can deliver it on time. That'd be really nice if you could. And then that whole private sector chain will rip itself apart to try and make sure that it could deliver at a price lower than what it's contracted you for. And it happens all over. The governments do this everywhere. I mean, you know, we do reverse auctions. We've done it for power. We build hospitals with scenarios where people bid by how much it costs per bed. I want a 600-bed hospital. Well, bid for me for how much it costs per bed. And the governments end up giving contracts based upon the number of beds for 10 years in a hospital. I mean, there's nothing new here. It's just people need to realise that it has higher scale. We do it in energy all of the time. We do it in renewable energy all of the time. We're going to do it in critical minerals probably. We're going to do offtakes in critical minerals. Why are we not doing it in one of this biggest area where if you write the contract for green commodities, then you actually trip off the contracts for the hydrogen, you trip off the contracts for the renewable energy because they all have to feed into the same scenario. It seems we're kind of like, hang on, something's going funny here. We're going to end up with all these policies around, whereas we could just write one big, fat, ugly contract, and that would trip off a daisy chain of activities right across the economy. It's just efficient. It's much more efficient than everybody filling out 400 grant applications, a bit of this, I'm going to get a bit of that, and I've got to put an application into this. It's just inefficient for the private sector. Make them bid, ask them to deliver, and run a process.
And actually, oh, sorry.
No,
No,
go ahead.
and I was just going to jump in there too, and this addresses another question in the chat that is related, which is, you know, well, what are the obstacles to this in terms of, for example, you know, the in Treasury, the risk aversion, this idea that the government can't and shouldn't play this more significant role. Actually, we see this as the least riskiest option.
Yeah.
Right. So Treasury, we think, should really like it because it actually reduces the risk exposure for the government. It does that in a number of ways. First of all, if you're just giving subsidies to a project, pouring in subsidies, there is no guarantee that that will actually ever get built, right? That project, you could spend billions in subsidies and nothing could ever happen. So with this, you're just saying, I will buy the stuff, like here's a contract for if you produce it, we will pay. And then, so that is entirely the private sector then wearing that risk of project delivery, but the contract enabling them to raise finance at a reasonable price, right, with that certainty. And then you offset the risk again because you say if the proponent delivers, and let's assume it does, we'll strip the environmental attribute from the physical commodity. We'll just sell the iron in conventional markets at conventional prices. There's no green premium problem. We know that market for iron, that market isn't going anywhere, right? That conventional iron market. So you sell that. Then you have these clean commodity certificates. The government absolutely is in 100% control of the value of those and for establishing a regulatory scheme into which it can sell them. So it then gets the money back. So this is just a really it is the least risky way. It looks big, but it's the least risky way. It's the most efficient. We would say it's the most effective. And the other thing, another question is, you know, well, who do we need another organization? Like, who's going to do it? No, we say we don't need another organization to start. CEFC or NRF, but probably most logically EFIC, could just write a contract as a start. And so it really is that. It really is that simple. So, you know, when we're talking about the multiplier effect of these kinds of approaches, that's what we mean.
Thank you. there's so many questions. I'm just going to say also that this recording will be available on the Institute website. Someone's just asked that. So I'll have to ask Dermot O'Gorman's, because I loved your quote too. So did he. Kicked in the ass by a rainbow. Great quote, Elizabeth. Having worked in Beijing since 2006 as China started their macroeconomic restructuring to scale renewables, the view is that those 20 years of Chinese effort to becoming a electro state, does that give us a rainbow? Also, my question is, who can take that rainbow opportunity from us?
Great question. Thanks, Dermot.
Dermot.
As always, Dermot. Yeah. Fabulous question. So, you know, China has created the opportunity because China is driving the momentum. Like, if China hadn't adopted this hugely ambitious approach to greening, we wouldn't be in a position whereby this is now the, you know, soon to be the most economically logical approach to which to go. So by driving down the costs of renewables, China has actually helped to make this a really viable approach, and it's driven that global investment logic. But of course, it's also driven a huge ambition of other countries. So, you know, we see in the Middle East that there's enormous appetite to start thinking about how to kind of capture similar opportunities around green iron and green steel, but using imported feedstock. So, this actually really is a race, and we often say that, but I don't know that we internalize it. But we really are in a race to establish ourselves as the supplier of choice in green commodities. And it's not something that will wait around. We can lose the opportunity, and it would be a huge economic loss given this impending cliff, like for our viability, our ongoing viability of our fossil fuel exports, but it would also be a big geostrategic miss, as I've said, with all of those opportunities for collaboration.
We're nearly out of time, but I did, Chris talked about the cost, what would be the cost to government, and you've sort of touched on this, and how does this political cost of compare with pursuing a carbon price instead of leaving it to the market? Short, sharp.
Short, sharp. So, if you have a carbon price won't necessarily actually drive. Won't, you know, carbon price comes at a value. Each project will have their own embedded carbon, and there may not be, the carbon price may not be enough to trip these projects off. I mean, I kind of simply look at this is that we've got to get from point A to point B, which is 0% carbon in these products by 2050. If you're going to run down that road, you may as well start doing it, right? And that basically means putting in a percentage of it needs to be required, which is a mandated solution. And if the mandates aren't in place today, and that's the problem that we've got, they are probably likely going to be in place. And if I could just point out one other thing, Peter, the reason why I like this policy is it enables the government to sign today, and it's got 4 or 5 years. But if we're going to build 6 billion of renewables, plus the green steel facility and the hydrogen facility, it'll be 4 years before it produces anything. Do we want to wait around 4 years before we've got the legislative scheme in place, before we even start the construction? Or this allows the government to go now, sign the contract, go and get it underway. The construction starts, and hopefully in 4 years, this will be a dud debate. This is the whole purpose of this. We'll be out of this business, and a policy mechanism like a mandate, like a global CBAM, like a one across Asia will be in place. Because logically, if you believe climate change is real and you need to decarbonise, you have no choice. This is a pathway that you have to take. And therefore, if we're going to have to take that pathway, there is no point in waiting. We need to start on that journey.
Excellent. That's time. I think it's you know, again, a really cogent argument on why government should perhaps be putting their money where their mouth is in this. And so, look, thank you both for taking the time to share. I think we've got another whole lot of converts here that'll be advocating for you. So we look forward to following this moving forward. And yes, we'll put the recording up on the website, and also refer them back to the website with all the readings. So thank you again. It's been really lovely to have you share these thoughts, and yeah, we're all behind it. So thank you.
Great, thanks. Thank you, everybody.
Thank you.
Enjoy your morning. Bye.
See you. Bye.